You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. Hey guys, welcome back to another episode of Market Champions. Today we've got Brandon Beylo, the value investor from Macro Ops, and you can find him on Twitter at MarketPlunger1. So thank you so much for being on the podcast.
Yeah, thanks so much for having me. I've been pushing it off because I've been nervous about being on this side of the mic, but we're doing it, so we're live.
Let's go. So I wanted to start off with your background, how you got into investing, and your journey to Wall Street, and how you got to where you are today.
Yeah, sure thing. So I'm trying to decide, if I want to do like a longer version or just kind of making a bridge version. But
you can make a longer version. I'm fine.
I've always been interested in money in the sense of, not the fact that I wanted to have all the money in the world, but just I thought it was a really interesting idea how people could barter or buy and sell things or make things and turn that into cash to then go buy other things that they would want. So from an early age, I was always trying new things, trying new business ideas. I remember, going to door when I was like a little kid, trying to shovel snow, started a lawn care business with my brother. It was called Bubba's Lawn Service because my mom used to nickname me Bubba when I was a little kid. And so I was like, I'll just call it Bubba's Lawn Service. Went online and did all the stuff to, register a name, started getting mail for this lawn service company. So I was doing a bunch of stuff like that and collecting baseball cards and always fascinated with numbers, but not in the sense of like that I was a numbers whiz, just that like I enjoyed numbers. So I could read the back of, say, someone's baseball card, and within, that same year, if someone asked me, hey, what's this person's batting average, I would be able to riddle it off within, a few percentage points here or there. So always fascinated with numbers, always fascinated with money and kind of how people made money. And from there, when I was in school, I was, still trying to kick around this idea of stocks and stuff like that. And it was in fifth grade. I had a teacher named Mrs. Wheeler, who I credit everything for getting my start in investing. So we had a stock market class inside of a computer class in fifth grade. And she sat us all down and I was sitting there at a computer and she says, we're going to do a game where everybody gets, I think it was like 1,000, 10,000 fake dollars. And we just put into an Excel spreadsheet, and she whipped up Yahoo Finance and said, type in the name of a company that you know. And so, I, back in the day when I was in middle school or early lower school, I loved sweets, kind of a fatty back then. And I was big on donuts. And so I was like, oh, Krispy Kreme, and typed in, she typed in the name of the company, and up popped the ticker symbol. And, I was trading like, something, I want to say like $14 or something like that. And she goes, so you can buy one share of Krispy Kreme and become a part owner in this business. Like, that's what she said. And that was, that's something you hear on every investing book and all these things. And I was getting it from my fifth grade teacher who taught, not only computer class, but a plethora of other studies. And so I sat there, I was like, wow, I love these Krispy Kreme donuts. I could be a part owner of Krispy Kreme. And so from there, it really catapulted. And I was just obsessed with finding stocks and finding companies. And then I went home and told my parents, I said, I need a brokerage account. And at the time I was going through, I think it was ING, and they had some sort of like custodial account that I made. So made the custodial account, got it all set up, just had my parents sign or whatever. And I asked my mom, I was like, hey, what kind of stock should I buy? And she was like, well, buy the things you know. And it's just so funny because, you've got people that you wouldn't think are investing, or people that you wouldn't assume would give you really great investing advice. All of a sudden, you've got my fifth grade teacher telling me something that I've read Joel Greenblatt say over and over. And then you've got my mom telling me stuff that Peter Lynch always talks about. So I was like, oh, okay. I was like, well, what kind of stocks would you buy? And she said, Whole Foods, Apple, and Disney. And what's funny is if I would have just bought those 3 stocks and left it alone since I was in 5th grade, I probably would have beaten upwards of 90% of the fund managers out there. And I wouldn't have had to do all this, fancy research and deep dives into these names that I do. But that was my first taste. And I just loved it. I loved it. And I couldn't get enough. So I started researching stocks, started reading 10Qs and 10Ks in 6th grade, 7th grade. And then towards middle school, I put it on hold because I was serious about playing tennis, and that kind of consumed my life. So I was trying to play and compete in college. So most of that time was spent playing tennis and trying to have some type of a social life, develop some really good friends. So I kind of put investing on the back burner, but always reading. So, reading the classics, Rich Dad, Poor Dad, just trying to still always kept in mind this entrepreneurial influence. So at the time I was doing, private tennis lessons to try to earn some money.
Right.
And so then it was my junior or senior of high school, which I think is what you're in. Gosh, you're like what, 17?
Yeah, I'm 17. Yeah.
So my junior year of high school into senior of high school is when I really got back into investing in stocks. And I remember using the school's printer to print off Coca-Cola's 10K because
did you get busted?
At this point I started diving into Warren Buffett, and I was watching his YouTube videos about how Coca-Cola had this amazing brand and how you can kind of, figure out a lot about investing by just reading a 10K. So I was like, I'll just print out Coke's 10K. And it ended up being like 467 pages or something crazy. And I was just sitting there in the study hall, like, oh my gosh, like it was a private school. So I was like, maybe my tuition pays for this. Like maybe this is booked into the price. But I just stopped it halfway through. It was like 180 pages. And the librarian was starting to wonder and look around, like, who is printing all of these pages? So I took this massive volume of Coke's 10K to my AP stats class and was just diving into it. And that was kind of the theme of my junior and senior of high school, is taking the time in class instead of learning the subjects that I probably should have been learning, like English, history, all that
You're
stuff,
basically
statistics.
doing what I'm doing right now.
Yeah, I'm printing off hard copies and just trying to read them like inside the cover of my textbook, so it looks like I'm reading the text material, but yeah. I'm not. And I remember sitting in AP Stat, and the teacher looks at me. He goes, "Brandon, what are you doing?" Because I had a highlighter. I was highlighting stuff. I was writing in the margins. He goes, "What are you doing?" Because he thought I was texting, because I was just looking down at the book. And I said, "I'm reading a 10K." And he said, "What?" And I said, "I'm reading Coca-Cola's annual report." And he took it from me. He said, "Give it to me." And so he took the 10K, the freaking huge ream of paper, and I got it back after class. And he was like, "Look, I think it's cool you're doing this. Just don't do this while we're trying to learn some other stuff." So that was kind of a long-winded version of saying that I've been obsessed with stocks ever since the 5th grade, ever since Miss Wheeler got me introduced, and it's evolved over time. Like I guess every investor's journey has, from trying to day trade to looking at these penny stocks, to really getting comfortable with what I think is my current investment philosophy. And hopefully it's one that I'm never fully comfortable with. It's something that I'm evolving over time and always trying to push the bounds of my circle of competence.
Right. So you basically started, like Warren Buffett did. I think Warren Buffett started in the 5th grade as well. So you're basically like Warren Buffett.
Oh, dear God, no. Ask me in 60 years if I have a track record north of 18%, and then maybe.
Easily, yeah. So I wanted to first start off with your research process and talk about how you source ideas, what you look for in companies and so on. So, let's start off with, how do you go about finding ideas to research?
That's evolved over time. When I started investing, I would screen religiously. I would run probably 5-10 screens. And the key part about that is they were all quantitative screens, right? Because I was trying to understand this game. And the easiest way to dip my toe into this game of investing is to do the quantitative measures of trying to find what I would define as value, which is paying less for something that you think is worth more in the future.
Right.
And so it was a lot of low price to earnings, low low EV to free cash flow, no debt, just stuff that everybody does. And I was trying to find those and researching names like that. And I was fishing at the higher end of the market cap spectrum, trying to find companies that I knew and thought that I could understand. Like Domino's Pizza was one of my investments that I made in high school. I was like, hey, back then when I wasn't eating as well, I consumed a fair amount of pizza, and which is funny because people listen, they're probably like, man, this guy eats pizza and freaking Krispy Kreme donuts. Like he's living to 35. But I would try to find things that I would understand. So like Domino's Pizza, anybody can look up an ROI number. And
Right.
so I'm like, oh, well, higher is better, all else being equal. And so I said, seems like a pretty good business, bought it at 18, sold it at 36, thought I was a genius. And, here I am without Domino's Pizza, and it's gone on to do incredible things. But I evolved from purely quantitative screens, I would say, in about my junior year of college, maybe senior year of college. I'm really starting to get a grip on what actually makes a business valuable. And it's not in a cheap PE ratio, and it's not in anything that you see in the current financials. And it took forever for me to understand that the intrinsic value of a business is actually what it does in years 5, 6, 7, and 10. And Michael Burry has a great quote, and I tweeted it out a couple weeks ago. I might butcher the numbers, but basically he said 76.8% of a business's intrinsic value is recognized, I think, after year 6 or 7. And so what that means is if you're going to buy a stock and if you're going to value a stock, what matters isn't current earnings, definitely not the quarterly earnings, but what the business earns in year 6, 7, and 8. And when you think about it that way, running quantitative screens that are based on current cheap valuation metrics just doesn't make as much sense. Now, I think that still works in different pockets of
Right.
markets. So I've said this before, and I always try to stress test this belief, but I think the more inefficient spaces you go into, whether that's emerging markets or just some really off the beaten path microcap stocks or something like that, I think that type of analysis still works. But in markets that have a ton of smart people looking at them every day, and the hurdle is not high for someone to be more sophisticated than me when it comes to analyzing an individual security. So I have no advantage over somebody if we're both looking at the same cheap quantitative screen. So that said, it really helped me adjust my framework to say, okay, well, let's look at it two ways. If this business has a high PE ratio today, what does that mean? Well, it doesn't necessarily mean it's expensive. It just means that the market's currently, valuing its future cash flows pretty high. Well, then, okay, well, is the market right in its expected future cash flow valuation? Like, will it be better? Will it be worse? Just like stuff like that. And then it led me to kind of getting rid of screens altogether in the sense that when I do screen now, it's very high level stuff. So the way I picture it is my screens earlier were like a really fine filter where you would call it, water or something like that. Actually, a better way to think about it is like if you're making cottage cheese and you want to keep all of that, all of the curds from going through. So what's left is very little when it goes through the strain. So that was my research process and my screening process. And over time, what it's now turned into is almost like an air filter where a few things get trapped, but for the most part, there's a bunch of names that flow out of the list. So I'll screen for high key metrics like revenue growth, gross margin,
Right.
and then just start from there, and then just go one by one, because sometimes what you find is the best stocks and the best investments won't screen well. And that's something that Matt Sweeney from Laughing Water Capital really reinforced for me. His letters are a treasure trove to read for any investor. But he always talks about finding these little structural issues that will distort the financials so that you won't even see it if you run a screen.
Right.
But maybe the company's actually cheap if you just look a little bit below the surface. So, it went from quantitative heavy to quantitative light type screening to now. I would say my research process is mostly just looking at Twitter and getting inbound idea generation from my followers. I passed 10,000 followers, which I think is just nutty. That 10,000
Amazing.
people
Congrats.
might even care a little bit about what about what I have to say. But there's also network effects there, though, because as your network grows, the amount of ideas that you receive grow, and it allows you to then kind of have like a venture capital type mindset where you're getting all this inbound leads, and it's just your job to either say no or to dig deeper. So I do most of that, and then I also look at 13Fs from some fund managers that I really respect. Cliff Soson's at CES Investment Partners is the first one I always read, and he's probably, I've said it before, he's probably the one investor that's completely changed the way I think about the practice and the craftsmanship that is investing. So I try to read his stuff all the time, but it's not much because he barely invests, and when he does, it's like one name, and so you don't get too many ideas from Cliff, but it's always nice. It's always a nice place to start. So yeah, I would say now it's very haphazard. Like I always used to listen to podcasts, and these really awesome investors would say, oh, you know what? My process is pretty, it's pretty serendipitous. I just kind of stumble upon some ideas. And I was like, that's not real. I was like, that's not how it really works. And now here I am, trying to develop this process, and I'm stumbling upon the same sort of conclusion, which I find pretty interesting.
So are there sort of any Twitter accounts that you follow that you think put out really good ideas to research?
Oh gosh. I follow, I think, almost 900 accounts. So if you just go to my profile and do that, I always worry about doing shout outs like that because I know I'm going to miss like a bunch of different accounts. So the only person the only person I'll shout out here is Alex Barrow at Macroops, because he is my partner in crime at Macroops. But yeah, if anybody's looking for some great Twitter accounts to follow, just go to my follows list and see who I follow. I think that's a good point because everybody I follow is miles smarter than I am. So you'll definitely get your value's worth.
Got it. So once you source an idea, how do you get started with your research? Do you start off with, say, reading the earnings transcript? Do you start off just straight by jumping into the 10K? Do you look at, go to Seeking Alpha, go to other websites, see if there's people who've already done analysis? So what happens after you find an idea?
Mm-hmm. Yeah. So the first thing I do if I find an idea is I read their pitch deck, their latest pitch deck, if they've got one. And the reason I do that is because the pitch deck is their best foot forward. So it's think of a company's pitch deck like going on a first date, where when you're first meeting this person, in this case, this is a company, they're going to show you their best self, right? So for instance, like if you're going on a date with somebody, they're not going to say, hey, by the way, I chew with my mouth open, and at night I steal all the covers, so you sleep cold. They're not going to do that. They're going to put their best foot forward, and companies are going to do the same thing, right? They want capital. They want an investor base for the long term. So if they have any aggressive strategic plans, they can leverage that base. So I'll look at the pitch deck, and if it doesn't pop out at me within the first few slides, because normally, the first few slides, like, hey, this is who we are, this is what we do, this is our competitive advantage. And if those things don't excite me, then I'll just pass. And, it's not to say that I'm passing on an idea because I think it's like boring or I think it's lame, because there's definitely money to be made in that. It's just, the longer that I've tried to improve my investing process, the better results I've gotten by saying no more. And so my first instinct is always to say no, unless something really pops out at me. And I've thought about this a lot, and it's funny because I don't want to sound like Chamath, where he's like investing in these like social archetypes, like, investing in companies so you can say you can invest in companies, because I don't want it to sound like that, and it's not. But what it is the fact that I want to invest in companies that I'm really excited about learning. And so this removes a lot of different types of businesses for me, and that's fine. I mean, I may pass on an idea that is a great value, but it doesn't excite me. And so I want to invest in businesses that excite me, because it's going to make me want to learn more, and it's going to make me want to do the due diligence that's needed in order to develop a thesis.
Mm-hmm.
And plus, it's your own capital, and you only get one shot at this life. And so you want to invest in businesses that you're excited about the future that they're trying to create. And so I'll read the pitch deck. And then if I like the pitch deck, I'll read the earnings transcript. And, that's just kind of to get a feel for, how management talks and stuff like that. I mean, none of this is groundbreaking. And after that, what I'll do is I'll go through the website a little bit more in depth to kind of understand the product portfolio, kind of how they try to solve customers' problems. And then from there, I'll go to Glassdoor and I'll see what the employees say about the business. And if the company's big enough, I'll try to find an NPS rating, which is something that I've added into my process. Again, all the stuff is like pure qualitative work. So I haven't really discussed numbers or,
Right.
dug into the financials at all, which is so different than how I used to invest even 2-3 years ago. And
Well, this is sort of like Phil Fisher. Phil Fisher used to do this kind of thing. He used to go around asking employees what they thought of the company and so on. So
yeah. I mean, and by no means do I do that level of in-depth research. And maybe we'll get into this, but I think I do the effective minimal dose, if that makes sense. I know Tim Ferriss is big on like the minimal doses. So like going to the gym and doing the least amount to get the most productive outcome.
And George Soros, has talked about how he does the minimal amount of work needed to actually reach a decision. So
yeah. And then you've got guys like Andrew Rosenblum that do probably the most in-depth work I've ever seen a single investor do. And obviously it's worked well for him. I mean, if anybody's listening, his returns are just stupid. Like they're just, I mean, if he keeps it up, he's a true market champion. I mean, he's somebody that could give Buffett a run for his money if these returns keep going. But yeah, so I'll go to Glassdoor, try to find an NPS rating. And then at that point, I kind of stop and I just think like, okay, does this business solve a problem that is actually a painful point for customers, whether that's a B2B customer or a consumer customer? And if that's the case, then I just try to think about how big can this market be in 5 years? And I'm not even, trying to do like, our TAM is huge. It's like, what's the end game here if this company has a solution to a problem and they can just keep solving these problems for these customers and adapting and meeting their needs. And so I'll think about, what the size of that market would look like. And then from there, I try to think of a reasonable, conservative, like, all right, how much can they capture of this market? And I try to be real conservative, because being too optimistic scares me, at least in the financials. Like, you have to be optimistic to be an investor, at least a long investor. If you're investing in businesses that excite you, you just have to be. But on the numbers side, I try to be very conservative. So I try to balance that out, because I know inside of me, if I'm optimistic about the business, I need to be conservative and maybe overpay for something, no matter how much I like it. And so from there, I'll kind of figure out, okay, well, if they can capture X% of the market, that makes them this big of a company. And then I kind of reverse engineer how they would have to do that and what the financials would then look like for them to get there. It's a bit of like Michael Mauboussin's market expectations investing, which, he basically says, take the stock price and then figure out what the market's embedded expectations are to arrive at that price. So I do a lot of that. And, I then go to the financials. Obviously I want to see a good business. And so what qualifies a good business is nothing new that I'm going to say, but you're looking for attractive returns on incremental invested capital. You're looking for a margin profile that fits the type of business. So I don't want to say just look for a high gross margin, because in different businesses or in different industries, a low gross margin might actually give you an advantage. And I'm trying to look for strong balance sheets, especially if it's, companies that are growing fast. I want to see that they've got the firepower to keep growing, especially the ability to finance their operations, in some sort of like liquidity event. It's not always the case that I do that, but these are just some top line things that I like to look for. And then, just try to figure out what, how the cash flow works in terms of the conversion. So, for every dollar in revenue, how much of that flows through to free cash. And yeah, I mean, it's nothing groundbreaking. So a lot of the work that goes on isn't in the financials. Cause again, if we go back to what I said earlier, the bar is very low for someone to come in and do a better job of analyzing a company than me. But at the same time, everybody can just put numbers into a DCF. And so that's not where the advantage is. The advantage lies in having a differentiated mindset of what the business is going to look like in 5 to 7 years. And so that's where I try to spend most of my time. And the DCF is just kind of the afterthought, like, okay, all right, yeah, this makes sense. And just making sure that there's a big enough discount between what I think the business can generate versus what I'm paying now. So, that's pretty much it in a nutshell. I mean, it's not super regimented. I mean, I've got an internal checklist that Alex and I use to kind of rank how a business looks. At one out of 100. We leverage Brian Feroldi's checklist there and developed our own internal thing. So shout out to Brian for giving us the criteria for that. But yeah.
Got it. And do you use sort of like price multiples to accompany, your valuation process, say like price to earnings or price to book? And, if so, is there like a maximum multiple that you would pay?
Yeah. So I don't use price to book, and that's not because I don't think it's a useful metric. I think it's a function of the type of businesses that I invest in. A lot of businesses these days have assets that are intangible. And so, you can have a business that has very low physical assets, right? So what a business looked like and what you could value a business 50, 60 years ago, you would look at their plant, property, and equipment. You would look at, the real estate they had on their books. And if it was trading for less than that and the company had little to no debt, that was pretty attractive. And investors like Walter Schloss made a killing buying those types of businesses. Right. I mean, if you just, ran a simple screen, right? Screens weren't really around back then, but if you could run a screen and just buy companies that traded for less than half times their book value, and they had strong balance sheets with little to no debt and had an operating business that spit off some positive cash each year, that was a great way to make 15 to 18% a year for decades. And Schloss did that. So I don't really use price to book unless it's like a hard asset play. But then again, I don't really do those just because, again, it goes back to invest in what excites me. And, buying a company for half its real estate value isn't, super exciting to me, at least. So I will use like a EV to EBIT multiple. I try to stay away from price to earnings just because both of those figures can be misconstrued. Michael Mauboussin wrote, I feel like he's written multiple papers about how both earnings and kind of the price and just how the PE ratio in general is not really a great heuristic to use. So I try to do EV to EBIT or EV to EBITDA if the EBITDA makes sense, because you got companies like WeWork that back in like legitimate business expenses and all that stuff. So yeah, I mean, what I'll do is look at those multiples, because at the end of the day, there's kind of two arguments in my head. It's like, one is a business is worth, the sum of its future cash flows discounted back to the present at some attractive discount rate. But then at the other hand, you've got Twitter accounts like Postmarket that do a great job of kind of red teaming this idea in public markets, because there's an argument to be made that a business is worth what anyone's willing to pay for it. And if you put it that way, there is legitimacy to putting like an EV to EBIT and saying, okay, in 5 years, what is a reasonable multiple that another market participant would pay for this business. And when I do those types of exercises, just to kind of answer that last question, like, what multiple wouldn't I pay over? I don't really think about it that way. I do think about it at the end when I'm trying to figure out like an exit multiple for a company and trying just to value a business. I don't really go beyond, I would say, like 20 or 25 times EBIT for a company. Maybe that's me being too pessimistic about what people are willing to pay for a business, but I try to stay around the market average, because if a stock is an incredible bargain at the market average, then I have a higher probability of getting an unexpected positive outcome if things go my way.
Right.
So it's about kind of framing that. I don't want to be surprised on the negative side. I would much rather be surprised on the positive side.
Got it. So I wanted to go and talk a little bit about something you mentioned at the start, which was looking into emerging markets for opportunities. And you've got investments in Brazil, you've got investments in Saudi Arabia. So my question was it sort of different to do research there than say doing research in the US? And are there different things that you look for in emerging market companies that you would or you wouldn't look for in an American one?
Yeah, those are good questions. So I will preface that with, I don't have any investments in Saudi Arabia. I've written about companies in Saudi Arabia,
Got it.
but gosh, it's hard to buy stocks in Saudi Arabia or Egypt. If I could, I would buy so many companies in Egypt. Thomas Bachrock and I actually looked at a really interesting company in Egypt, and I was so upset that I couldn't find out a way to buy it, but Thomas did, and I think he's at PFH Capital. I should know that. He's turned into a pretty good friend, but he's a great contact for emerging markets. And I would say my criteria for an international investment does not change at all. The only thing that changes is the rate of return and then the discount rate I use, because going into another market, an emerging market like that, especially some of these, like Saudi Arabia, Egypt, these really off the beaten path emerging markets. It's funny, I have to be careful how I say emerging markets, because twice now on Twitter, I have referenced purely 100% developed countries as emerging markets, which is so stupid. I've done it twice. And the replies are really funny. I think it's Thunderdome Capital. He always replies. Yeah. He always replies. And I'm like, dude, I know I just messed up, but it's funny. He is a great follow. But yeah, nothing changes about how I view the company, right? Because businesses, if you go back and you think about, businesses, they're kind of like us humans in sense of what is a business, but just a collection of a bunch of biological humans that operate on similar physiological and psychological, emotional paradigms, no matter where you are, right? So obviously there's some cultural differences here, but for the most part, as humans, we've kind of evolved together as one species, regardless of where we are on the planet. So
right.
That said, the companies that spring from these collections of humans, whether it's in the US or whether it's in Egypt, are roughly similar. And so the competitive advantages and the types of businesses that I look for are also similar. So, if I'm looking for a great business with a durable advantage that solves customers' extreme problem and delights the customer by doing so, and in doing that generates substantial cash for the business over a long period of time, that's not going to change between whether I'm in the United States or whether I'm in Egypt. The one thing I will say is, in emerging markets, you have a better propensity to find monopolies, whether that's just natural monopolies or government sponsored monopolies. So Saudi Arabia is a pretty good place for government backed monopolies. So for instance, I wrote about STC Mobile, which used to be, it was a government sanctioned mobile telecommunications company that they spun off and privatized. And the great thing about that is the company kept its massive advantages of scale and market share, even when it became a public company. So I would say, yeah, the The only difference is just a higher discount rate. If I'm doing 10% across the board in US companies, which is what I do anyways, I just do a flat 10% discount rate. I learned that, well, not really learned, but I applied that. I forget who the guy's name is. I want to say Pratik, but maybe I'm wrong. But the guy who runs Escalating Capital.
Samir Patel.
Yeah, see, I was totally off. Samir Patel. I saw in his pitch deck that he did just a flat 10% discount rate. And so I was like, I love this. So in the US, every company I do is pretty much 10% discount rate, unless it's like a very venture type investment, then I'll do 20, 25% discount rate. But if I'm looking in emerging markets, I mean, you would start 15, 20% just because you have to get paid for that additional risk of investing in a place where if you've never been there, and if you don't necessarily understand the culture, don't understand the governance, then you need to be compensated for the risk that you're taking.
Do you ever go like on foot to check them out, or do you just?
So it's funny you mentioned that. Alex and I are doing a macro ops travel / investing show coming up this year. So we're actually going to be traveling to these countries and talking to management and getting boots on the ground research while providing a hopeful, entertaining experience to the viewers. So I'm super stoked about that. But no, not right now, but yes, in the future.
Got it. So one thing that I wanted to ask you was, you are part of macro ops. So does the macro as a whole influence, how you pick stocks? And if so, okay.
No, I think it's that way just because I'm not smart enough to play that game. If I was smart enough, I think it's a benefit that I am not smart enough to entertain that idea, because I can see the allure of trying to pick these major macro global, like Alex does a great job of doing this because he thinks in ways and on levels that I just can't. And, having that ability, I can understand why it would be so tantalizing to let the macro influence the micro. But for me, what gets me excited and what I can spend, years talking about and just hours on end is businesses and what makes businesses tick and what makes one business better than the other, and the individual intricacies about a business, and like what problems they're solving, how one business looks competitively disadvantaged today, but actually in 10 years, this could be a fantastic business. Those things really get me excited, and I could talk about them for hours. And so that's what I focus on. I will say that Alex does give me a better appreciation for how much liquidity impacts markets. So Stanley Druckenmiller had a great quote, and he's one of my favorite investors. He had a great quote where and I'm gonna butcher it, but I think he said, it's not earnings that move markets, and it's not, institutional flows that move markets. It's liquidity. It's what the Fed does. And to a large extent, you've seen that with this, free money, these quote unquote stimmy checks, and you've seen what it's done to the stock market. So in that sense, it's given me a greater appreciation for the power of macro,
right? But
I don't let it influence my decisions. And if I start doing that, then it's a sign that I am deviating from what I believe to be my core competencies.
Got it. So do you sort of use liquidity to sort of time your entries into the market, or do you just use liquidity as something you just watch in general, but you don't really use it at all?
Yeah, I just use liquidity as more of like a mental model to kind of gauge flows and just to understand how this huge economic machine that we call the equity markets and capitalism works. But besides that, I mean, the more I let that influence my decisions, I think the worse my incremental returns would be.
Got it. I also wanted to ask you, how do you use technical analysis when you invest? Do you use it purely, if you wanted to trade or if you wanted to speculate, or do you use it to time your entries into the market? If it breaks out of, if it breaks this resistance zone, it's got better odds when I go long of continuing to go up. Or do you use technical analysis at all? Or
I do. And it's funny because, as a quote unquote value investor, someone that buys stakes of individual businesses, not pieces of paper. I can hear like the pitchfork sharpening and the flamethrowers or the torches lighting, because when you just think about it, those two methods are polar opposites, right?
Correct.
One, you're looking purely at price, which from a value investor's perspective, the current stock price means absolutely nothing about the future of the business. But from a technical analysis perspective, that camp says price is everything, and
fundamentals
prices
are factored into the price.
Yeah. And fundamentals are funny mentals or something like that. I think who was it? Didn't Paul Tudor Jones say something like that? We said it's like funny fundamentals or something like that, where basically fundamentals don't matter. And what's funny is being exposed to both camps gives me a greater flexibility in flowing back and forth, where I don't feel like I have to identify between both. I think both can live in harmony. And I think both can give you strategic advantages at different points in time.
Right.
So I do use technical analysis. And when I say technical analysis, I'm not talking about Fibonacci charts, although I'm always quick to say that for some traders that works, right? And it's a self-fulfilling prophecy. So if enough people use it and enough people thinks it works, then it'll work, just like classical charting. If I can draw support and resistance levels, if I'm not the only person drawing those, and if there's other people drawing, again, you kind of have these interesting network effects where if you get a bunch of people drawing the same support and resistance lines, and if a stock breaks through that resistance, and if enough people have identified that, then it's a self-fulfilling positive feedback loop where enough people are going to say, oh, well, that's breaking out of this quote unquote technical range. So I love charts. I love charting. It's something that I started doing my senior year of college. I bought Richard Schaubacher's book, Technical Analysis of Stock Market Trends. I am obsessed with Peter Brandt. And the fact that I guess I'm following his episode is just stupid to me, just because he's a legend. And
absolutely.
I've watched every single YouTube video. Like, I was so jealous when I saw you talking to him. I was like, damn, like he is my charting idol. That's amazing to interview somebody of his caliber at your age is an incredible feat.
Thank you.
So I've been obsessed with charting, and I don't know if it's the visual side of my brain that just enjoys seeing beautiful patterns. I mean, I do. I think patterns are beautiful, and if I see a nice rectangle pattern, or what Nicholas Darvis calls the Darvis box, if I see that, I'm just going to draw it because I love it, and I'm going to say, okay, cool. Well, if it breaks out of this, then there's probably a higher probability that it's going to go up. And so, in that sense, my use of technical analysis is on a spectrum, usually dependent on the market cap, or usually as a function of the market cap. So if a stock is either illiquid or smaller in market cap, I won't use technical analysis, because the benefits of technical analysis are in the liquidity that stock has, and your ability to get in, and other people's ability to get in and get out, where you have nice clean patterns, nice clean breakouts. Also, with microcap stocks and more illiquid names, you have a greater chance of one shareholder or one large position unwinding, affecting the entire price. So if it's a smaller name without liquidity, I won't really use any sort of charts. That said, if the stock gains liquidity and starts, trading more, daily volume goes higher, you can, I do incorporate some sort of technicals. And on the bigger names, and this is something that really got me interested in macro ops when I was applying to, work with them, was their ability to flow from this fundamental base to then using technicals, almost as like a fundamental technician. And so on these larger names, what we will do is use technical analysis on longer term timeframes, because the shorter the time frame, the more noise, obviously, but it also redirects your internal mindset to thinking about Like if you're using a 4-hour chart, what are you thinking about? Well, you're thinking about the next few hours. And even if you're using a daily chart, you're thinking about, okay, the next day, the next few weeks. But if you're using a weekly or monthly chart, what are you thinking about? You're thinking about months. You're thinking about these long-term bases, these long-term consolidations, and you're trying to position trade. You're trying to get into a position that you can hold for months and years. And other institutions are as well. So, I'm not the only one that uses it. There's a bunch of firms out there with large pools of money that are trading fat lines that rely on technical analysis to pinpoint their entries and exits. And they're using the weekly and monthly charts because they have so much capital that they can't get in and out as easily. So they can't use the daily charts. And so if you look at the weekly and you look at the monthly, you can almost see sometimes the institutional buying and selling, the consolidation. So
Right.
Alex and I use that, and we use that to time entries. And we also use it to help manage risk. So we'll have like an initial risk point stop loss where if we buy a stock and it gets, it goes immediately against us, we'll be out for a, 50 to 100 basis point loss. That's not always the case though. We've had investments where we've said, look, we're going to put a 2% position on, we're going to put a 5% position on, and we're just going to let it go. Like this is a long-term hold. Like there's no stop loss here. I will say the danger with stop losses is you can get shaken out of a really, really good idea. And as easy as it is to say, oh, we'll just get back in if it breaks out again. I mean, that's really easy to say, but how many times has that happened to me where I get gun shy and I'm like, I don't want to take another loss. And so having wider stops, I think is a nice marriage between the fundamental aspect and trying to apply some sort of technicals. Technical analysis works the same way value investing works because it doesn't work all the time. And I think a lot of people are quick to discount technical analysis because it doesn't work once, or it doesn't work twice, or it doesn't work 3 times, where the whole premise of value investing is kind of the same thing, where Joel Greenblatt would say, hey, value investing doesn't work all the time. And that's why it keeps working. And I think that's true with technical analysis as well. I mean, just listening to Peter Brandt talk about losing streaks and drawdowns, and, a chart pattern is not going to have 60, 70, 80% accuracy.
Absolutely.
If you have proper risk management and if you let your winners run, you only need 30%, 30, 25%. So yeah, I love charts, and it's probably one of the biggest differentiators I have against other, value type investors. Is it's something I definitely use, and it's in my toolkit.
Got it. If you think about it, in a sense, the reason technical analysis works is because, everyone sees the chart pattern, takes a position based off of it. And, value investing works because, other people see that there's value here and they take a position in it. So in a sense, both of them are, in a way, self-fulfilling prophecies, if you think about it.
Yeah, but it's also a little bit deeper than that, because you can go one layer further and say, like 2 people can take the same breakout trade, and one person can have better A, risk management, and B, understand and let a winner run and kind of give it some room. And so you can have 2 traders take the same breakout and have completely different return profiles.
Absolutely.
Just like you can have 2 different investors buy the same exact company and have 2 different completely 5-year return outcomes, because someone understood the business better, or someone, someone was adding when they should have, and some people were trimming and they weren't actually letting that positive volatility tail risk take them to that next level of returns. So there's a lot more similarities between how we think about value investing working or investing working and how we think about charting working.
Right. And, one thing that you mentioned was this idea of risk management. And, Peter Brand was sort of stressing on this idea of risk management. Basically all, or at least most of the market wizards stress on risk management as being key. And I wanted to ask you, when you think about position sizing, do you sort of take starters and, take a small 1% position? You said at the start that you do the minimum work that's needed to actually, come to a conclusion. And based on, so if you find an idea interesting at the start, you just take a small starter position and build with time. And the other thing is that, Soros and Buffett have both talked about, betting big and, their lack of belief in diversification. So do you buy into that, or do you focus on staying diversified?
No, it's one of those areas, right, where I live in a gray area because I'm still evolving my beliefs on each of those. So I'll address the first question in terms of position sizing and starter positions. So Alex and I do take starter positions. The way that I think about that is, on one hand, yes, there's an argument that you should never invest a small amount in something if you wouldn't invest a large amount. I think Fred Liu at Hayden Capital talks about this, or maybe it's Dennis Hong at Shaw Spring, but they often say, look, if we're not willing to put up 10% of our portfolio capital into this name, then we shouldn't put up 1%. Absolutely. And I get that. I get that from a conviction and just from a hurdle rate in the portfolio. That said, there is benefits to investing in public markets that you don't have in private markets. And the more I've thought about it, I think some investors do hemorrhage themselves by being too ruthless on this private market action in public markets. What I'm trying to say is that there's really good things about public markets that you can't do in private markets, where public markets, you can get into a stock, and if, it doesn't work out, you can get out. You don't have that necessary benefit in private markets. So I try to be cognizant of that. And the way I think about it is, if I have researched a stock, and it doesn't really take me long to know that I would want to buy it. I think if it takes you longer than, let's see. I mean, if it takes you longer than like 15 minutes, 20 minutes to decide if this is something you want to buy, then it's probably not a great idea to begin with. But I mean, I have looked at stocks before and sent them to Alex and been like, this is a freaking great idea, I think. I just dove into it. I'm liking what I'm seeing. I'm liking, whether the chart is lining up right at that moment, or, if it's kind of bouncing around, consolidating. Mm-hmm. I'll say, look, I like it. We could put a 1-2% position on and just have a stop loss there. So while we're doing work, if it trades lower, we're out, call it 25 basis points. So you get into the opportunity cost of that capital. And if the idea is good, and if we know we're going to do further research on it, I think having that 1-2% position with a potential risk of losing 25 basis points, I think that's a better opportunity set to deploy our capital than to keep it in cash. Just because if we're right on the idea and we've got a small starter position, if we're right on the idea, we can scale in from there. And if we're wrong, then we can get out with, like I said, basically a rounding error loss. And Mark Minervini, who's been in a bunch of Market Wizards books, and he's, one of the best traders, that I've read. He has that philosophy where, like, if he's up big, he'll take half profits. And he always says that psychologically, that's the best bet, because if it keeps going up, you can tell yourself, oh, well, sweet, I still have half my position. But if it goes down, you can tell yourself, okay, cool, I booked half profits at that price. And I think that's how I and Alex think about it as well in terms of starter positions. It's, okay, cool, we've got this position on, we really like the name, we're going to keep doing work. If the stock price falls, we'll get hit for a 25 basis point rounding error loss. And if we really still like the business as the stock price is falling, then that actually gets us more excited about reinvesting back at a lower price, which would give us a higher future return. Then on the flip side, if the stock keeps going up, we're not sitting there on our hands like, damn, I really wish we would have at least just gotten in and started that position, because that's also real too. And I think the pain of not getting into something that ends up going up is way more painful than the pain of just losing 25, 50 basis points on something that you thought was interesting, and you're going to keep doing work. Now, that said, I wouldn't structure an entire portfolio around 100 different starter positions, because you're, employing transaction costs and, if
Right.
it's just not an economical way of doing it. But yeah, I mean, if you've got a couple names here or there, it's something Alex and I do. And I think it's perfectly normal, but I get the other side of the argument. I totally get it.
Got it. So to wrap up the podcast, I wanted to ask you, what makes the macro ops process different? Yeah.
That's a good question. I would say what makes the macro ops process different is we have one of the most ruthless mindsets that there's always something new to learn, and there's always something that we can gain from learning and using other methodologies. Like you mentioned earlier, and like we talked about, using technicals with fundamentals. What Alex does on the macro side, and what we've developed with the trifecta lens score, where we can score, basically on a scale ranging from +6 to -6, where +6 is, hey, we've got breadth, we've got liquidity, we've got sentiment, all going in the right direction. Bull market's running, to -6, which is, hey, this thing is prime for, the market's prime for severe correction, stuff like that. So I would say it's just the ability to not be dogmatic about everything, question everything, always iterate, always improve. And the one thing that makes us different that I've seen from other research services is Alex and I, we never advertise that we're the smartest investors. We never advertise that we have everything figured out. We call the macro ops the collective a collective on purpose, because we get better with everyone else in the collective. We learn alongside our members learn from us, we learn from them. We develop these awesome feedback loops. We've got hedge fund managers, we've got former entrepreneurs that have created and sold businesses. We've got prop traders, we've got big institutional clients in there. And it's just this nice consortium of different trains of thought that are all obsessed with one goal. And that's, to create and make the highest adjusted risk adjusted returns, or highest absolute returns on a risk adjusted base over a long period of time, and have a hell of a fun time doing it. And so Alex and I are always quick to not think that we have everything figured out. When we write up a company, we want our members to say, hey, you might have missed this, or hey, you might have missed that, or have you thought about this? Have you thought about that? And in doing so, we're able to craft a portfolio, and we're able to craft a framework around just trying to make money and not trying to just be right. And it's taking a lot of it's taking a lot of what Ray Dalio says at Bridgewater, which kind of makes sense because Alex used to work at Bridgewater. So culture bleeds from the top down, and what Alex has created at macro ops is incredible, and it's such a blessing that I've been able to work with him day in and day out, and just learn from someone who I think is one of the best traders right now. And so culture bleeds from the top, and it's just this mindset of question everything and try to develop a process that you can stick to. And the returns are what they are. They were good last year. They could have been better, and we're off to a good start this year. But it's not about what we did last year. It's not about what we do this year. It's about developing a process where we can find really good ideas and help our collective members structure their own portfolios, or help them track our portfolio in a way that they understand, in a way that gives them the tools to then find ideas. Because the last thing we want is a collective or a research service where it's all outbound, where it's all Alex and I sending people stuff, getting nothing back. The best type of network, the best type of research service and community is one where we're all learning, we're all giving each other ideas. So I can send out an idea and get 5 back. And we've got, this beautiful Slack community where people share ideas all the time. And so I think that's what separates us. Yeah.
Absolutely. Any closing thoughts?
Oh man. It's already been an hour. I feel like it's been 10 minutes, but I guess, closing thoughts.
You're probably going to be on more podcasts after this.
Closing thoughts is just, it is humbling. It is humbling to look back and see the progress that I think I've made as an investor. Not trying to say that I think I figured it out, but I read a tweet from, I think it's Henry Stebbings, who does the 20-minute VC podcast. And he was talking about a therapy session he went to, and his therapist was talking to him and suggesting that he does, I think it's like banking small wins or banking small victories, basically overemphasizing and really balling out on small victories for people that have a hard time celebrating small achievements. And it's something I've wrestled with because I suffer. If you haven't already heard it in the podcast, I suffer from imposter syndrome pretty big time. I always feel like if I have an idea that works really well, it wasn't because of me. It was because we were in a bull market. And if an idea didn't work, it was because of something I missed, not because, the general market went down or because, just stuff happens. So I struggle with that a great deal. And
I think that goes back to sort of like the Scott Bessing quote where, he says that, the movement of the stock is 50% general market, 30% the sector, and 20%, the alpha that comes from actually picking the stock.
Yeah, exactly. So, whether if I have a good idea and it does well, I'm always quick to discount it and say, it wasn't really me. I think I got lucky. We've been in a bull market, it is what it is. And if something goes bad, I'm always like, man, I must have missed something. Like, I got to get better. I'm slacking, and that definitely eats away at you. And so one of the things I would say for others that are listening that maybe struggle with it as well is, you're not alone. Even the people who I think are the sharpest investors on Twitter, sometimes I'll confide in them and they'll say, dude, me too. And I'm like, wow, okay. But yeah, anybody listen there, just try to take the time and give yourself, throw yourself a ball if you do something that results in a small win or a big win. Investing can be a lonely game. We've got the internet that connects us, but at the end of the day, it can be a very lonely game. And so the more you can give yourself the support that you deserve, I think the better. Because, we started this podcast talking about Warren Buffett, and there's a reason him and Charlie Munger have done so well. It's because they've stayed in the game the longest. And I think one of the only ways you can do that is if you give yourself a break and learn to celebrate those small wins. And I will give a shout out to one of my good friends, Brad Hathaway, who runs Farview Capital. And we are discussing, some ideas that I've thrown around with him, and some have had the benefit of rising pretty significantly. And I basically confided in him. I said, look, I don't really know how to celebrate these types of things, because if a stock does well, I just move on and, just turn over another rock, just keep going. And he said, well, find something that you like to do and just do it. And I like going to the beach. And so I took my fiance and I to the beach. So yeah, that's a super long-winded thing, but it's something that's been on my mind constantly. And it's something that I struggle with. So
yeah, thanks for sharing that. And thank you so much for being on Market Champions, Brandon. It was awesome having you.
Yeah, man, I was nervous, but I think it was pretty fun.
It was awesome. Thank you.